Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about Tesla stock as well as Nio stock, along with other electric vehicle companies to determine how well they can actually hold their value during a stock market recession. We're going to start off the video talking about Tesla's TSLA share price and why it has surged after their Q2 earnings. So we're going to be going over their latest news updates as well as the latest stock news regarding if this company can actually maintain their current stock price. So we're going to be going over the latest stock price targets and price predictions for the TSLA stock. Then we're going to move on and we're going to talk about Nio stock and why the Nio share price could surge over the next 12 months all the way up to $67 per share according to this article. Then lastly, we're going to have a few minor news updates regarding some other electric vehicle companies such as BYD, XPEV, and Li Auto. But the majority of this video will be focused on Tesla and Nio. So for more electric vehicle news updates regarding Tesla and Nio, or even other electric vehicle stocks and companies, comment your favorite down below, subscribe if you are new, smash that like button right now, and let's just jump right into today's stories. So Tesla, as you probably already know, is an electric vehicle manufacturer, but they also do a plethora of other things, but we're mainly going to be focusing on their electric vehicle capacity. The TSLA share price, which is their ticker symbol, has shot up more than 30% just in the month of July following Tesla's very impressive second quarter results pertaining to their revenue and their EPS that they brought in. According to this article, the author thinks that the TSLA shares are actually overvalued right now and that it's a real stretch for investors to decide to invest into the TSLA share price right now. Now, I'm going to be giving my own opinion on this as well because I do tend to disagree with this particular financial reporter on multiple things, but we are going to hear out their argument because I do think they make good points. Because when we are investing into a company, we need to weigh both the positive and negative news against each other to determine our own risk management policies and our own risk tolerance. So the main thesis of this particular author says that investors are underestimating how the economy is going to go into a recession and how Tesla's share price is substantially higher than what the company should be worth right now. He points out that the company currently trades at a PS ratio, or a price to sales ratio, of around a 12. So they're trading at around 12 times their forward price to sales, which for an automaker is rather high right now, especially with other electric vehicle companies and rivals starting to develop their technology over the coming decade. So it's going to add more competition for Tesla. Now, just right off the bat, I honestly don't think that a PS ratio of 12 is actually that bad for a growth stock such as Tesla, and we'll talk about that more later in the video. However, because I think that Tesla is a good long-term play, let's look at their long-term growth trajectory. So Tesla right now has consecutively beat on their earnings and revenues, and they've made quite a habit of this, mainly due to their strong delivery numbers. Tesla as a company and the TSLA stock price looks like it has fantastic momentum as we head into the period of quote-unquote economic sluggishness, according to this author. Tesla overall has a very strong brand name and a very impressive lineup of various vehicles and models on top of amazing technology. This gives Tesla a unique competitive advantage in regards to their moat, especially in such a hot market such as the electric vehicle and EV market. So this makes us think, is Tesla stock worth the premium on its price tag? So to start off, I agree with the author. Tesla is trading at a premium. If you look at their financial metrics and any accounting ratios, they are trading at a premium. But this should not shock investors because basically all growth stocks are trading at a premium because investors are investing into these companies based off of the future stock price appreciation, not the current stock price compared to their current financials. Many bullish investors say that the premium for Tesla is justified because they are a technology company that makes automotive electric vehicles rather than an automotive company with very good technology. And that is a very important distinguishing factor because Tesla is not just an auto manufacturing company, they are a technology company that makes automotives. This is why if Apple, ticker symbol AAPL, ends up entering the electric vehicle market, this is going to be a huge blow to Tesla. There's been immense speculation that Apple is going to make an all-electric vehicle that is going to be completely autonomous, which is going to launch later this decade. However, I do agree with the author in this particular regard because Apple, I think, would be very intense competition for Tesla. Apple is literally classified as one of the most high-end innovative technology companies in the entire world, which would certainly add major competition to Tesla, thus lowering the TSLA stock price and increasing the AAPL stock price. Now, for me personally, I own both Apple and Tesla shares, so for me, it's a win-win either way, so it really doesn't bother me. However, for other investors who are very heavy into Tesla, it may be time to diversify into other large tech companies, especially tech companies that could end up breaking into the electric vehicle market. The author goes on to argue, if Apple ends up joining the electric vehicle market, the premium for Tesla is going to look less appealing for investors, and the TSLA stock price would fall. However, currently the TSLA stock price looks pretty good over the long term, even though in the near term, we could see the TSLA share price start to fall. According to Wall Street, Tesla has a moderate buy rating from around 18 analysts who have a buy rating, 6 analysts who have a hold rating, and 7 analysts who say to sell the company. If we look at their current projections, the current company trades for around $906 per share, while the average price target among professionals is $873.97. Now, the low-end price target, which to me is an absolute joke, goes as low as $73, and the high-end price target is $1,580. Now, for me personally, I think a good price target for Tesla stock is $1,300 in the next 12 months. However, we're just going to have to wait and see where the TSLA share price goes, especially if the United States ends up entering a recession, because clearly that is going to weigh heavily on the majority of growth stocks, including Tesla. Now, what about other companies across the world that are also releasing very innovative electric vehicles, such as Nio? Well, according to this article, they think that Nio, which is another electric vehicle company, could surge in their stock price from around $20, which is where the current stock price trades right now, to $67 in the next 12 months. So let's see why he thinks that. He says that it's been very hard lately for electric vehicle companies over in China, which would include Nio, XPeng, Li Auto, and BYD. However, he says that Nio was disproportionately affected by the recent shutdowns that the Chinese government decided to implement, which has clearly slowed down the amount of vehicles that they've been selling and delivering, which is negatively impacting their overall EPS and revenues. For instance, in the month of July, Nio reported that it delivered around 10,052 vehicles, which would equate to around a 27% year-over-year increase, but a 22.4% decrease sequentially from the previous month. For instance, in the month of June, the company delivered 12,961 vehicles, which is substantially higher than the 10,000 that they delivered in July. And in an ideal scenario, we would want these deliveries to continuously increase and never decrease. So far in the year of 2022, Nio has delivered 60,879 vehicles, which is up 22% year over year. Now, this doesn't compare well to other Chinese EV makers such as Li Auto. For instance, Li Auto reported for the month of July that they delivered 10,422 deliveries, which is more than what Nio delivered in the month of July. And for the year of 2022, they delivered 70,825 vehicles as of right now. Lastly, we have XPeng, which is leading the pack, who reported 11,524 vehicles, which they delivered in July, which is a 43% year-over-year increase, so clearly they are scaling very rapidly, and for the year of 2022, they have delivered over 80,000 vehicles. Another huge update for XPeng is that XPeng has recently started a partnership and working with Alibaba, and this is a huge development for this particular company, because this would be similar to a company like Lucid Motors or Fisker teaming up with Amazon. Now, clearly these parallels aren't 100% accurate, but it just gives you an idea of how huge this actually is. XPeng is really breaking away from the other EV makers over in China, and they are doing very well from a competitive advantage standpoint, especially by working and using technology alongside Alibaba's cloud division, which is absolutely phenomenal. And the reason why XPeng is doing this is they are trying to attempt to challenge the giants of Tesla and Warren Buffett's BYD, which is another phenomenal automaker that I would encourage you to do your own research on, because XPeng is trying to beat these major giant companies to the punch of autonomous electric vehicles and potentially a taxi service. So what happened with Nio? Well, Nio, before the shutdowns, actually reduced production on purpose in order to retrofit and increase their production production capacity later in the future. So they needed to work on their production facilities temporarily, which lowered their overall production and delivery numbers, and then along with the shutdown, this absolutely flattened their competitive advantage to where now all three of these electric vehicle companies, which would include XPeng, Li Auto, and Nio, are all relatively around the same competitive advantage right now in terms of production capacity and delivery numbers. To this day, Nio still hasn't fully returned to their full production capacity because of various supply chain issues, which are affecting all of these electric vehicle companies. However, according to this article, Nio is intended to accelerate their overall production numbers during the third quarter of 2022, and then from then onwards, we could see Nio absolutely take off, which is why this author thinks that the Nio stock price, which is their ticker symbol or ticker name Nio, could absolutely surge to $67 per share from what they're currently trading at right now, which is only $20. So over the long term, this particular author says that Nio shareholders should not be concerned, mainly due to Nio's growth rate. Nio has a phenomenal growth trajectory, and they are producing many different types of vehicles to fit into the electric vehicle market. So they are identifying a variety of different segments and markets that they can elevate their overall bottom line. And this is what I mean by that. Nio has a complete set of vehicles that revolve in several different segments within the electric vehicle market. They are not just trying to target one particular segment, which not only makes them more diversified, but it also helps them increase and grow at a more competitive rate due to their plethora of models. To give you an example, would you rather buy a company that only sells electric vehicle trucks, or would you want to buy a company that sells electric vehicle trucks, electric vehicle sports cars, and electric vehicle sedans? Clearly, the company that is more segmented into a plethora of various markets in the long term is going to have better margins and potentially more revenues because they are trying to serve more customers. And in Nio's case, it's very similar, even though not identical to the example that I just laid out. So there's no doubt that over the next few years that Nio is going to make something of themselves as long as they don't get delisted from the US stock market or US exchanges, which we have done videos on in the past. So if you don't know anything about that, I would encourage you to go check those out. But overall, for the long term, I think Nio is positioned very well. I think that investors should definitely start looking at other electric vehicle companies over in China, particularly BYD and XPeng. However, that's not to say that Nio is not going to be the winner over the long term, because as they start adding new models and continue to expand their brand globally, along with some more secretive projects that Nio is working on, such as the sub-brand codenamed Alps or ALPS, which is something that we could look into later, depending on how interested you are in this particular video on Tesla and Nio. But I would love to hear your thoughts down below. Remember to comment what other electric vehicle companies you want me to cover. Subscribe if you are new, smash that like button if you haven't already, and I will see you in the next YT video.